Stock buyback. You may have heard about this term more often these years.
Well, it's the comeback of the buyback.
Buybacks more than tripled from a year ago in January.
And also approving this new share repurchase program, authorizing up to $40 billion in share repurchases.
Buyback plan after completing a $10 billion buyback plan that was approved last November.
Alibaba, after boosting its share buyback program by $25 billion.
In 2022, the world's top companies spent $1.3 trillion on repurchasing their shares, a trillion with a T, almost equal to the $1.4 trillion the same firms paid in dividends during the year. In Australia, ASX 200 companies have spent over $36 billion on buybacks in the last 3 years. Why is everybody obsessed with stock buybacks? Is it a smart tactic companies use to benefit all shareholders, as it should be, or is it some sort of magical tool? Today, we're going to unpack the dark side of stock buybacks. Wikipedia defines stock buybacks as the reacquisition of a company's shares from existing shareholders. When a company buys back its shares from the market, the total number of shares on the market decreases, with the company's earnings remaining the same, therefore earnings per share increases. This makes the company appear more profitable, boosting stock prices. This is why we sometimes see a rise in the stock price even when the company makes a stock buyback announcements.
Shares of Uber moving higher today after the ride-sharing giant announced that its board of directors has authorized the repurchase of up to $7 billion of the company's common stock.
Let's say the company has 1 million outstanding shares and earns $10 million in profits. Its earnings per share, EPS, would be $10 per share. If the company buys back 100,000 shares, reducing the outstanding shares to 900,000, its EPS will increase to $11.10 per share. Shareholders who don't sell now own a bigger part of the pie, and their shares are worth more. Stock buybacks were actually illegal in the US for much of the 20th century because they were seen as market manipulation. Back then, dividends were the main way companies returned cash to shareholders. But everything changed in 1982. In 1982, the SEC legalized buybacks, which became a go-to tool for company executives. In 1980, about 78% of companies used dividends to reward shareholders. Fast forward 38 years, more than half of US companies were using stock buybacks in 2018. Between 2003 and 2012, companies in the S&P 500 spent 54% of their earnings on buybacks, totaling $2.4 trillion and 37% on dividends. If done right, they can benefit the company and its shareholders. If a company doesn't need extra cash for innovation or expansion, buying back shares can make the remaining shares more valuable.
As long as you're telling the truth to your shareholders about what's going on so that you aren't manipulating the stock downward or something, when a stock can be bought well below its business value, that probably is the best use of cash. It's something the Washington Post did on a huge scale. And that was the reason a very significant percentage of companies bought stock back in the past, because they actually thought it was selling for less than it was worth. Like I say, that can be abused if you do various things to bury your stock in one way or another. But that wasn't the usual case. Stock repurchases were relatively unpopular in those days. They've become quite popular now, and to the extent that I've been around a good number of them and been able to pick up on what I thought was the underlying rationale, if not the professed rationale, I think it's often done for people that are hoping that it causes their stock price not to go down, and often done at prices that don't really make a lot of sense for continuing shareholders.
And buybacks can offer tax benefits to shareholders. Remaining shareholders who don't sell their shares defer their capital gain taxes, while shareholders who participate in the buyback often pay a lower tax rate than dividends. If all the buybacks were executed based on the reasonable theories we just mentioned, stock repurchases would sound like a better option than dividends. But this doesn't fully explain why companies are so obsessed with buybacks. In 1982, when stock buybacks were legalized in the US, another rule called 10b-18 was passed. This rule gave executives total power and a blank check to determine their incentive-based compensation, which has created a huge problem behind stock buybacks. For established public companies, stock-based instruments like options and stock grants make up the majority of executives' pay. Companies award higher bonuses and equity ownership for them achieving better performance marks. Executives can be showered with awards if they successfully move one performance level to another. Let's take Brian, the CEO of a large accounting software company, for example. His company repurchased shares valued at $500 million, which added around 5 cents to the company's annual EPS. This allowed Brian to surpass his $5 EPS target by a single cent. Despite the company's deteriorating performance, the buyback secured a $1.5 million bonus for Brian and increased performance pay for the company's other top executives. By artificially inflating some performance metrics, corporate executives get undeserved compensation without improving the company's intrinsic value. The extra cash they used to repurchase the shares should have been used to optimize the company's productivity and performance. A recent Goldman Sachs study reports that in the real world, EPS growth outpaced actual earnings growth by 2.6% due to stock buybacks. The improved performance yardsticks reached by stock buybacks are responsible for about a third of a CEO's pay on average, or almost $4 million per CEO. The strong tie to executives' compensation isn't the only way they can cash out from buybacks. They can also engage in insider trading. SEC Commissioner Robert Jackson documented that while in the days before a buyback announcement, managers traded in relatively small amounts, less than $100,000 worth. During the 8 days following a buyback announcement, they sell on average more than $500,000 worth of stock each day, a 5-fold increase. The huge benefits to executives' compensations motivate them to conduct excessive buybacks. However, share buybacks are not foolproof for boosting a company's EPS and stock prices. They can actually do a lot of harm to the corporate structure and disturb the stock market, potentially creating a market bubble. Lesnick and 2 other economists argue that share buybacks are dangerous for the economy, especially when executives finance them with debt. Temporarily inflating share prices and other financial metrics to enrich themselves is unethical. Lesnick also points out that around 1980, corporate behavior shifted from a retain and reinvest philosophy to a distribute and downsize philosophy, which has become a major concern.
They've used their gains not to reinvest in themselves or in, plant and equipment and everything you're talking about, but that in fact that all they've been doing is buying back stocks.
Alex Edmans highlights that companies should first make all value-enhancing investments available to the firm and then use surplus cash to repurchase shares. Over-reliance on buybacks can lead to missed opportunities for long-term growth by neglecting investments in productivity and innovations. Buybacks can also disguise poor business performance that actually needs the extra cash for improvements. Recognizing the negative impact of opportunistic stock buybacks, Congress implemented a 1% excise tax on corporations that repurchase their own shares under the Inflation Reduction Act, effective January 1st, 2023. For example, Chevron will owe $750 million in excess taxes as it carries out its $75 billion buyback plan. Despite the additional tax, buybacks don't seem to be slowing down. In addition to Chevron, Meta, the parent company of Facebook, announced a new $40 billion buyback plan, and in early May 2024, Apple announced the largest share repurchase program in the US history. If this trend continues, a 1% excess tax isn't likely high enough to significantly impact the tax disparity between dividends and buybacks.
If they had in fact invested in the production to keep gas prices down, instead they used the record profits to buy back their own stock, rewarding their CEOs and shareholders. Corporations ought to do the right thing. That's why I propose we quadruple the tax on corporate stock buybacks and encourage long-term investments.
How high would the buyback excess tax need to rise to par with the taxes on dividends? When a company uses its shareholdings to repurchase its stock, it signals that it has fewer productive investment opportunities. Surely, the public can use this tax revenue for productive projects that will benefit the society. So what do you think about stock buybacks? Have you participated in any share repurchase programs? Share your thoughts and experience in the comments below. My name is Irene. I'll see you next week. Bye.